boop 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 boop. As long as you're ready, Thomas, we'll get started.
I'm ready.
Okay, so hello guys, thanks for tuning in this week. So we have a special guest today, coming to talk to us about some really cool stuff that may or may not affect all of us. So, Thomas or Tomasa, however you want to be called, will you please introduce yourself?
My name is Thomas Reilly or Tommaso, either one. And I've spent the last 25 years in the financial industry, and I'm here to talk about money and banking and current events, things like that.
And this is just an informational interaction where we're going to talk about this and discuss some of your ideas that are just personally from your experience.
Correct. This is informational only, and this is not intended as advice for anybody or anything.
Because the banks want to hide information from the common man. So, yeah.
Is that
suspicious. Yeah.
It
That's
could-
what we agreed on
it could
before
be.
we started recording, right?
It could be. That's
Yeah,
it. Yes.
yeah.
Yes, we did agree on that.
It's all a conspiracy.
It's a conspiracy.
Yes. Well,
Yeah.
some people may come away with that idea as far as who I am, but I'm going to try to do the best I can.
Perfect.
Okay.
So let's start off by asking you, some of your past experience and getting some of that history, and then I would like to get into some of the history of money itself.
Okay. I spent about 25 years in the financial industry. The last 17, I was a financial advisor / money manager. So I helped people invest their money, and that's how I made my living. So I've been involved in the financial industry off and on for 25 years, the last 17 of which was as a financial advisor when I retired here to Blacksburg. And what I realized was, after figuring out what was going on, I figured out that maybe I didn't want to be in the financial industry because I didn't really understand how things were going and how things were working. So in 2010, after the financial crisis, I spent a lot of time on the internet. As a matter of fact, I'd stay up till 3 o'clock in the morning, and my wife would say, "Have you solved the world's problems yet?" And I said, "I think I've got a handle on it." And I'd wake up the next day and go, not really. And I'd get on the internet some more, and I'd dig. And so what I learned was that things are not operating the way they should. And I think what I want to do is talk about the history of money in a little bit, and what money is and how it was created, and now how it's created today. So initially we had gold or silver or commodity coins that were developed by the Byzantine Empire, the Greek civilization, Rome, and those coins were commoditized because they were created in exactly the same way. And so one coin was 1 ounce of gold, for example, and people had a lot of confidence in that, because when they got that coin, they knew exactly what it was worth, and everyone else knew exactly what it was worth, and people used that to trade and buy things with. Now, what ended up happening was, in all situations, governments usually want to fight wars or raise money. Kings want to raise money, and so what they'll do is they will do a number of things. One, they started shaving their coins, and then they started making the gold coins, for example, in the case of Rome, smaller and smaller, and tried to say that was had the exact same value as a coin that was minted in a larger size, right? So they were kind of that's where coin shavings came from. People would shave the coins a little bit so that there wasn't an ounce of gold. There was maybe 90.95% gold, and they would shave all the coins and take those shavings, and then they would melt it and create more coins. And that is what we call inflation, more money in the system.
Wow.
Right? And so there were a couple of civilizations that created these coins, and they made the bankers go through a process. They made the bankers go through a character test, and only certain people that passed these tests could become bankers. The Byzantine Empire was one of them, and they created a coin called the solidus, which is very similar to what the Italians call soldi. And so the solidus was a coin that had so much integrity that it traded for 800 years, long after the Byzantine Empire went bye-bye, if you had sold us, it was as good as gold, right? Because it was gold, and so the integrity of the money was very important, and so what ends up happening is the kings or queens or governments decide they need more of it, and so we went from having gold coins to paper that was backed by gold or silver or whatever. Typically, it's gold.
So some type of representation.
There was some physical commodity that everyone thought was valuable that they could trade these paper things in to get the gold or whatever it was. And so when governments needed more money, they decided they were going to cheat. So what they did was they said, we're going to issue these paper things, and at first they said, we're going to have a relationship between the gold that we have and the paper that's out there. And what happened was kings wanted to get in wars. They needed money. They needed to pay their people, right? So they decided that they were going to, by decree, saying this is a legal tender. And so all of a sudden we had this thing called fiat money. It was partially tied to gold, but not completely. It was money only because the government said it was, and it had nothing behind it, or very little behind it in terms of value. And so as long as people had confidence in that, things went smooth and swimmingly. But once the government started printing too much and creating inflation, then all of a sudden people wanted to revert back to their good money. And so people started hoarding. They hoard the good money, and they spend the bad money. It's a common thing. I think it's called Gresham's law, which says that bad money will crowd out good money, right? So if you think the dollar is worthless, you're going to spend it and get rid of it for anything you can. And by the way, if you have gold jewelry, gold coins, you're gonna hoard that stuff, and so that's what happens. So right now, so in 1944, we went on this standard. Bretton Woods was the place in Vermont where everyone came together from around the world after World War II to set up an international monetary system. And they said that it's going to be based on the U.S. dollar. The U.S. dollar will become the world currency, and it will be it can be exchanged for $35 per ounce of gold. Right? So we created this paper money, but it was backed by gold. So what happened was we got into a war in the 1960s, the Vietnam War, and Lyndon Johnson wanted to fight the war, and he also wanted to implement all of his social programs, Medicare, Social Security, not Social Security, but Medicare and some other programs. And so what happened was Medicare came back in the 30s, Medicaid and a few other things. So what happened was he went to the central bankers and said, hey, what's going on? We need to print more money. And so then it became 40% backed by gold. And so the French, under de Gaulle, decided that instead of when they accepted dollars, because they were exporting more to the U.S., right, and receiving dollars for those goods. So instead of keeping those dollars, he started saying, we want our ounce of gold per $35. And so that was a problem for the U.S., right? So Nixon decides in 1971 to temporarily get us off the gold standard. Now, once you do that, here's where it comes into play in the banking system. Once you say that the amount of money that can be produced, either by the government or by banks, is not tied to something of limited quantity, then you can print unlimited amounts of money. And once you print unlimited amounts of money, sooner or later it becomes worthless. Right? And so every fiat currency out there has never survived, ever. And so now we have this thing called a fiat money currency, because our currencies are nothing more than pieces of paper or digital entries in a computer that say you've got money. So once we got off the gold standard, all of a sudden the banks were allowed to make more loans, because one way that money is created is, one, it can be it can be printed. So you pull out your dollar and it says reserve currency, the Federal Reserve. You can have gold coins. You can have just paper money. And so what the U.S. has done, the Western countries have done, is they've allowed banks to create $9 of more money for every dollar they've got on their books. They can create $9 more in loans. And so they just create this thing called a loan document. You owe me, if I'm a bank, you want to borrow $100,000, Joel, I have to have $10,000 in my account somewhere, and then I take that $10,000 and I electronically put another 90 in your account, and you've got the money. It's created out of thin air. Now, people hate it. Economists and bankers and finance guys, they hate it when you say banks create money out of thin air, because they always say, no, there's a loan document, and a loan document is your promise to pay me back with future money, right? So if I give you a $100,000 loan, either one of you, you have to pay me every month out of your future wages. And so they say, no, we're not creating money out of thin air. We're creating money out of we are encumbering your future income, right? And that there's value there. And my point is that we're not going to know that until after the fact, because you might be good, you might pay it back or you might not. Mm-hmm. What about the people who don't pay it back, right?
Where does it go?
I'm creating money out of thin air, right? So we're now at a point where the banks, and if I brought my computer, I could show you the amount of debt that's been created in the system. And so starting in about 1980, about 10 years after we went off the gold standard, there became a disconnect in terms of the amount of money that was created and the economic activity that was being done, right? And so you really want a connection. Mm-hmm. There has to be a relationship between the stuff that you make and buy and stuff and is made in the economy, that's called GDP in our case, mm-hmm. and the amount of money in the system. And so you can see a chart where the amount of loans just goes up like a hockey stick, because banks didn't have any restrictions on the amount of money that they could lend to you, because they only need $1 of what's called reserves or cash on their books to make a $10 loan. So what the Federal Reserve did, they're the central bank, they always made sure that there were excess reserves in the system, so that if you as a bank didn't have any reserves, but Brittany was another bank who had excess reserves, you could do what's called a swap arrangement, which is Joel says, I've got these great securities. Now, Brittany, you've got the cash. I will temporarily sell you the securities, and you'll give me some money, and you'll make some interest the next day when we reverse the transaction, when we swap back, okay? And that's how a lot of banking goes on behind the scenes, is that banks are always lending money to other banks. And there's, in the banking system, there's always excess reserves. Individual banks might not have it, but they can very quickly, through a computer system, find out who does and how much they have to pay to borrow those reserves to make loans. And so now there's an unlimited ability to make money. And most of that is nothing more than, it's not based on anything other than the ability of the borrower to pay it back. That's it. And about 80 to 90% of all money in the system is created by bank money, by banks, by loans.
Wow.
Yeah, it's monumental. So what happened was we had these monumental loans being created, and there was no relationship between the GDP or the output, and they went through the roof. And in 2008, we hit a wall, and that came in the form of the mortgage problem, the mortgage crisis. But the tech bubble, which was 10 years earlier, in 2000, it was the same issue, only the things that were being abused, the market that was abused, were high-tech companies, the tech bubble, right? We call it the tech bubble. And so if you create money and you allow people to have access to it in any market, prices will go up. So here's an example. I do this in class all the time. I create a bubble in my class every semester. So I give people $20,000. I give them a little $20 bill from Monopoly and say, this is $20,000. And I say, I'm only going to give you $80,000 of a mortgage. It does, and so if I have 100 people or 1,000 people, if they only have 20 grand, and I only give them $20,000 or $80,000 of loans, then none of them can buy a house for more than 100 grand.
Mm-hmm.
And so prices will stay stable. If I say to those 100 people, I'll give you unlimited amounts of money through a mortgage,
Mm-hmm.
what do you think they're going to do? Prices are going to go up because you want that house, and the guy down the street's bidding $250, and you say I'll pay $255 or $270, and all of a sudden prices go up, and that's what created that housing bubble. And so so when the bubble crashed, it was because people couldn't pay back their loans, so the promise to pay went away, right? And then banks stopped lending money because they were hoarding cash because they didn't know which bank they were dealing with behind the scenes was going to pay them back the next day, right? Because maybe I was lending you money or Brittany money, and I didn't know one of these two is going to go, and so I want to hold on to my cash as much as possible. And so then when real people came in with real issues and wanted to borrow money to open up a business, or to supposing Virginia Tech here says, I want to help local developers, so we're going to have a low bid construction project. And supposing one of you win it, and I'm the banker, and you've been banking with me for 35 years, you have a $200,000 contract, and you bring in this contract and say, look, Tom, I've got this piece of paper, and tech is good for it. I need 100 grand because I need to hire more people, I need to get more supplies, I need working capital. And I say, nope, sorry, Joel, I can't do it because I'm hoarding my money, because maybe Brittany's a bank and I'm overexposed with her. I've lent her a lot of money, and I don't know, right? And so I'm going to hoard my cash. And so in the real economy, things shut down because we need borrowing in the real economy to get things going in some cases.
In the real economy, okay.
Or in the real world.
Interesting.
And so that's kind of what happened. And it's all based upon the fact that banks were allowed to create unlimited amounts of loans, and unlimited amounts of loans and debt is really the opposite of that. That opposite of that same coin is money. So they create money for you, but they also create a debt instrument that I own if I'm a bank, and that's my asset, right? So I'm just creating money, giving it to you, and then you are going to pay me. You promised to pay me, and that's considered an asset.
Interesting.
Right?
So really is almost like making some type of money out of thin air. You're originally, Thomas, I was thinking that we should start our own religion, but now I'm considering starting our own bank.
Bank. Yes.
Because it sounds like I can almost take $1 and just say I have 10.
Yeah, you can if you're a bank, exactly. Yes, and there's a guy named Bill Black who was a regulator in the S&L loan crisis in the 1980s.
I'm sorry, did you say the SNL loan crisis?
Savings and loan.
Oh, okay. Different SNL. Okay.
Different SNL. Yes. Bill Black, he basically wrote a book, The Best Way to Rob a Bank is to Own One. Because basically those guys, the bankers, basically, they control the money supply. And there's a couple of famous economists that basically have said that those who control the money supply control the country. Forget the politicians, because they can get paid off, right? So historically, there's always been a connection between bankers and politicians, or kings. Because the kings or politicians always need more money to
Wherever
do
you get
things,
the policy,
right?
you start seeing where the money comes from.
Exactly. And so the politicians who always they never want to raise taxes, right? The king doesn't want to raise taxes. They don't want, they don't want to get pitchforked. So what do? They create more money out of thin air. They find a way.
Wow.
And so the only way that things work is if you have a very disciplined way to control the money supply.
Okay. Man, that is intense. That sounds like quite the history of money, starting from, sounds like actual gold coins and or a resource that everyone agrees upon,
Yes,
right?
Some commodity.
Some commodity. And eventually that becomes almost like a shared lie, where
Yes.
you're like, okay, this means something.
Yes, there's an island in the South Pacific, I believe, that used seashells.
Yeah,
Certain
that
seashell.
makes sense. As long as everyone agrees to the same line.
Exactly. That's how
It
bubbles
becomes
are.
real.
That's how bubbles are created, right? So bubbles have been created for centuries. Here's another classic example. Most everyone's heard of the tulip craze in
Yes.
right? So the most prized bulb was a bulb that created a white flower with a red line in it,
Mm-hmm.
and that went for roughly $400 for one bulb.
Wow.
One day it was worth $400. Literally the next day it went down to 25 cents.
Wow.
Why? Because the shared mania, right?
Yeah,
You're talking about the
yeah.
shared, and that red little vein that was created was in that bulb was actually a virus. So people were spending $400 for a
For a
bulb
virus.
for a virus with a bulb with a virus.
Wow.
Yeah, kind of crazy,
Yeah.
Interesting.
right? So since then we've had a lot of bubbles. We've had the tech bubble. Bitcoin was a bubble.
Mm-hmm.
The stock market is can be technically considered a bubble now. The bond market can be technically considered a bubble. So what's happened here now is let's switch gears.
Yeah.
So we've talked about how money's created. We've talked about how a ton of money's been created in the
Yeah.
last 20 years. Way too much debt. Right? We know that we've got a debt problem. We know that based upon the long-term averages from 1900 to 1980, before we really went haywire. The amount of debt in the system was about 165% of GDP, and it oscillated up and down like a system would. And that includes private debt, consumer debt, business debt, and government debt. We're now in this country at around 375%. So we've created about 200% more debt than the system typically has in it over the past 20 years. Does that make sense?
Yeah.
And so it's not sustainable because now what we're doing, what debt does, debt can be used for one of two things. You can either borrow money to invest in plant and equipment or a business, something productive that's going to grow the economy, or you can borrow money to buy your motorbike or buy your house or just buy stuff, right? So the amount of money that's being invested for growth has been flat for 20, 25 years after adjusting for inflation, right? There's been no growth in terms of money being invested for plant, equipment, and hiring people and doing all those things. Most of the debt that's been borrowed has been borrowed to buy stuff. And because the house was an asset and it always went up in value, everyone thought that was a good thing. Everyone thought that tech stocks that never made money, that were being bought for $100 a share, $200 a share, that were worthless, at the time, everyone thought that was a good idea.
So just making more and more bubbles. I mean,
Yes.
really, it just sounds like, at least here in America, we're almost sitting in like a big old bubble bath for ourselves.
Well, the real issue is that the entire world is sitting on a bubble bath because the Chinese have created 400% debt to GDP. The Europeans about 400% debt to GDP. And so Japan is even worse. And so when you add those four places up, the U.S., China, Europe, and Japan, it represents almost 2/3 of the output or production of the world.
Okay, so now we've seen the transition from actually having a resource that we agree upon to now we have way more percentage of debt to the GDP that we have,
Yes,
right?
yes.
So looking at some of the future aspects, and maybe this might be more theoretical finance, but how do you see the effect of, say, analytics or computer analytics or machine learning or deep learning or the capabilities of putting computational power to trying to understand market movements and resource movement? Do you see that creating a larger bubble that will eventually explode? Do you see it maybe ameliorating some of the problems that we're seeing with this ratio?
Well, in terms of understanding it, you don't have to be a rocket scientist. You don't have to be a rocket scientist or scientists like you guys who are good with statistics and math to see this stuff. So here's a hopefully a amusing story. Finance is built upon a couple of major tenets or premises, and one is the efficient market hypothesis, and that means that nobody can figure out where the market's going to go or an individual security is going to go in the short term. So I just explained this in class today. When I was young, I went to a party in Connecticut, And
Yeah.
I got my buddy worked for ESPN, and so we went to Connecticut. He said, "Come on up," and I went up with about 4 or 5 friends. We went to this. We had this party, and bottom line was the keg came at 7:00, and there was a guy named Smitty who came at 7:30. He was totally drunk. And by 11,
Yeah.
So by 11:00, we're in this house, and it's an old Victorian house with a septic tank. And when you bring 200 people into a backyard, you got 3 or 4 Ks going at the same time. Flush. By 11:00, half the backyard was a septic pool. Right?
Wow.
So we're sitting in this screened-in porch, and one of my friends said, "Look at Smitty," and Smitty is basically teetering on the edge of the septic leak. And this guy says, $10, it says Smitty falls in 10 seconds. And before someone could say, "I'll take that," boom, Smitty went down. So the markets are supposed to be like a drunken fool. You never know which way they're going to go, right? They could go up this second, they could go down the next second, but you never can predict that. So you're talking about analytics and AI and whatnot.
Yeah.
So there's a lot of controversy about algorithmic trading programs.
Okay.
Okay? This is where I'm headed.
Man, this is interesting.
So algorithmic trading programs are computers that do trading, and so there's a company called Virtu, and they wanted to go public, and so what they, in their prospectus and in all of their their documentation, they said we made money 1,275 days out of 1,276 days. They lost money 1 day out of 5 years. They held the average stock holding period was 11 seconds. So that to me tells me I don't need any more analytics than that. It tells me something's wrong there. They're skimming
Right.
profits out of the system, right?
Yeah.
And it's that simple. And I've heard people say to me, "Oh, but they're smart people. They should be able to make money." Right? And you say, "Well, no, yes and no. Look, I'm a smart guy. You're a smart guy. You're a smart girl. Why don't we all get together? We all work for different brokerage firms, and we get our relatives who have different names, and we pump up this penny stock, this real small stock, and we pump it up, and then we go to all of our clients,
Yep.
and we get them to buy it, and when it goes up enough, we start selling it back to them,
Yep.
and we make a killing."
Yeah.
Right? That's called pump and dump. You can't do it. It's illegal. Right? It's called a pump and dump scheme. And so you pump up the stock and then you dump it to some sucker.
Right.
That's illegal. 5 years in jail, $50,000 fine. Right? Yet high frequency trading programs can do the exact same thing, but because they're doing it in a split second,
Yeah.
they don't get cracked down on.
Wow.
And so people say, "Oh, well, these are just smart physicists who have developed these programs and algorithms to take advantage of the market." They're not taking advantage of the market. They're taking advantage of the software that the market uses to create a market.
Yeah.
And that's different,
Yeah.
right? It's different. And so to me, it should be made illegal. But it's been made illegal in Germany, but in this country, it's not.
It's not. So you can just rake in all of this income without ever producing any single benefit or value to society
Correct. You can just
whatsoever.
You can skim off profit, and don't forget that the market in general only has a certain amount of profit. So if you take excess profit out of the system, what does that leave me? Because if they're making money, who's losing?
Somebody's got to lose it, right?
You're right, exactly. And so it's totally, in my opinion, corrupt. Okay.
It sounds like just another avenue for wealth accumulation, and you have that constant division where we have all of it aggregating at one little point.
And the Federal Reserve and the banks are exacerbating that program. They're not making it better. So the reason why is because the people who get the money first get to buy the stuff at cheaper prices. And so if I'm a Wall Street banker and I'm lending money to other speculators and they get the money first, they can buy the houses and then start bidding up prices. But the first people in get the stuff at the lower prices, and the last people out get screwed, right? Because when the selling starts, the last person out sells at a low price.
Right. So whoever has the largest amount of financial capability and power will continue to have that, just based on that control.
Yes.
Right? So that sounds like a scary development for how analytics is affecting, and it sounds to me almost like in a deleterious way to our society, because now we're skimming and reducing the capabilities for people to actually produce resources and benefits to society and you start having that wealth aggregating only at central points, i.e. central places.
Yes, and it's even worse than that, because in finance, there's something called the risk-free rate, and that's the basic building block of return. Right? So in finance, one of the basic tenets, there's two basic tenets. The more risk you take, the more return you want. But the more risk you take, the less the probability that you're going to make that money. Right? And so there's a building block that says the risk-free rate is something that it's the 10-year government bond is a proxy for it. There's no such thing as a risk-free rate. Okay, but the 10-year bond is a proxy for that, and you're supposed to let that rate be determined by the market. And if you suppress that rate for a long period of time, then your building block for risk and return go, because risk and return go hand in hand, right? The more risk you take, the more return you want.
Right.
Well, the risk-free rate maybe now is 2%. It's the 10-year government rate. And then you start building what's called a risk premium. You want a higher return the more risk you take, right? And so what's happened is the entire way that people allocate their investments has been distorted because the risk-free rate has been distorted. And so there's something called price discovery, and capital markets are supposed to be good at discovering what a good price is today for a specific investment is. But the minute you start distorting the risk-free rate, you start distorting the returns for all the risk classes, and you start distorting prices. Because if you distort the risk-free rate, it makes it seem like the return you need gets less and less and less, right? Because if the risk-free rate were 3% and you had a 4% risk premium on top of that for a certain investment, now you're going 2% plus 4, and you need a 6% return, right? So here's how the value of an asset is calculated. You take all these future cash flows, and you discount it. You divide it by 1 plus the return you want, and then all of those together, added together, you come up with what's called a present value or a price. So if you lower the denominator in each of those calculations, what happens to the price? It goes up. Bubble.
Interesting.
Okay? So the reason why I say it's worse is because the other issue is that many people or entities or organizations, pensions are a classic, they need a certain rate of return in order to pay out their benefits. And typically it's 7 or 8%. And so what's happening is when you suppress interest rates for very, very safe bonds, like government bonds, traditionally you could get a 5 to 7% rate of return with a high quality bond fund of government bonds and corporate bonds.
Okay.
Right? But now you can't get 5 or 7%. And so in order to get your 5 or 7% in your bond portfolio, you've got to go out to more risky investments.
More risky investments.
More risky investments, right? So what's happened is when we have the next crash and all those junk, they're called junk bonds because they're bonds from crappy companies. Can I say crappy?
We say fucking shit all the time.
Oh, good. So
How are we going to get to the younger audience, Brittany?
The younger audience.
With your dirty potty mouth, constantly.
yeah, I know it's dry material, but I'm into it. I'm into it.
I mean, I don't fully understand all of the numbers behind this financial, I guess, analysis.
What it's doing, let me give you an example that really makes sense. You'll understand.
Okay.
We've got this thing called the fracking industry.
Right, fracking industry. Yeah.
Fracking industry is basically a Ponzi scheme.
Okay, sounds like a Ponzi scheme. Fracking sounds terrible. The word displeases me.
I'm not even talking about fracking for oil.
Yeah.
I'm not talking about the effect on the environment. Well, I'm talking financial.
Financial. Okay. Financial. Let's forego the obvious, straw man of the environmental problem.
Correct.
Let's talk about the financial.
So here's how
criteria.
A report just came out. 44 out of 48 companies studied by this one financial analyst group found that 44 out of the 48 lost money. So from an economic point of view, fracking doesn't work because what happens is about 75 or 80% of the oil from a well comes out the first year. But what ends up happening is the costs then after the first year go way down for that well, right? But the cost of maintaining that well don't go down that much.
Right.
You can instead of having 10 people,
It still has
maybe have 8.
operational costs.
You have to have the operational costs don't go down. And so what ends up happening is if a fracking company starts 100 wells, the first year they got tremendous revenues and it looks great. And they look profitable because they can spread out some of those costs over 30 years. And so it looks like they're making money. The problem is that in order to keep that up and have growth, they've got to do another 110 wells next year, right? Because they get almost no production from the first year's wells.
Right.
And so the only way to grow their revenue and to grow their earnings is by increasing the number of wells every year by a certain amount. And those wells cost money. And so now we've got people who are investing in these companies because they're borrowing money at 6 or 7%. Why? Because those companies are really crappy companies and they have to pay a little higher rate. In the olden days, those companies would pay 15 or 20%, but now they're paying 5 or 6. And so people are chasing it's called chasing yield. They're trying to get they're trying to get a little bit more return, and they can't get it by investing in safe government securities, right? You can't even beat inflation.
True. Yeah.
Right?
At this point.
So what's happening is the banks are trying to lower the interest rates now so that more people borrow money. And so they're trying to solve a debt problem with more debt.
I mean, this seems like a reoccurring theme I've noticed.
Yeah.
And the very little financial history of it I've understood is that you constantly have this cycle.
Yes. And in the olden days, when banks made too many loans to bad people, we had little recessions and we had contractions, and then everything got wiped out and we started again. And now what we've done is we've just created so much debt, and we've created so many behaviors that go counter to productive things. I've mentioned a couple of them, and again, I'm being very random, but investing money in a fracking company is fool's gold. You're hoping that the next round of financing will pay off you, and the other sucker will be left holding the bag, right? And sooner or later, the music stops and something's going to happen. So right now, the economy's good and fracking companies can get all this money, but the minute that the banks and other investors say, no, there's too much risk there for the return I want, then all of a sudden they're not going to have enough cash to create those new wells, and their revenues are going to go down, their stock's going to go down, and they're not going to be able to pay back their bonds and the bond holders.
Wow.
Right?
Interesting. So that's very important research that people have done in order to see these trends, right? And what I typically see in research papers from economics normally is what I read. They do a lot of case studies about things that have already happened, right? They do a lot of trend studies that has already happened. So can you accurately predict, like we were saying, the analytics starts to predict the market and start scraping off those profits by trading every half a second or 0.1 second, right? So you have these algorithms that are capable of seeing in the future by a second or a few seconds, and they can get the profits. Kind of?
Kind of, yes.
Okay, so
the big thing about algorithmic trading is what they do is they buy orders from other people, so they can see who's trying to buy what at what price.
Okay, so with that knowledge, the field of finance and the study of finance, which in a minute I'll probably ask you if you think finance and economics is more of a art or a science, but is that like a modern day soothsayer if you talk to a financial person or an economist where they're trying to predict the future based on past events and they're not so good at it like maybe the weather people decades ago? Or do you think that now with the information and technology we have that the branches of finance are capable of getting to the nuances and understanding market movements?
No.
Okay. All right.
No, because the system that has been so distorted by the money that's been created and thrown into it that no one can have any idea what's going on. Plus, people talk about free capital markets. There's no such thing as free people. There's no such thing as free capital markets. Even capital markets have degrees of influence by outside forces. Now we've got central banks, and they're so involved in the market that no one knows what they're going to do. So here's an example. The Bank of Japan decides they're going to buy these stocks in real estate to keep the real estate market up. That is never what a central bank is supposed to do. Okay? A central bank is never supposed to do that, right? A central bank is never supposed to suppress interest rates for 10 or 20 years like we've done in this country. And so when the stuff hits the fan the next time, first of all, we're going to have negative interest rates probably, which is a totally insane thing. And I'll explain that in a minute. But if the central banks decide they want to buy every piece of stock certificate out there, they have an unlimited amount of cash to do that. And so they can always, the world can go to hell. Seriously, I mean, it can go to pot, and we could have a stock market that's through the roof.
Yeah, of
It
course.
just doesn't mean anything, right?
Yeah, it doesn't mean anything. It's a shared lie.
Right. Because one of the things that a stock market is supposed to do, it's supposed to be a virtual reflection of what's going on in the real system, right? Plus, savings is nothing more than it's future consumption. So if we've got all this money and our economy is not growing, when people like me who are going to be retired and start to sell those investments for cash, there's going to be so much cash in the system, and I want my loaf of bread, right?
Right.
And if it costs me $10, I'm going to pay for it. So the stock market at its level now is really it's latent inflation. Okay, because people say, oh, we should have inflation by now. The Fed's printing all this money. Where's the money going? Well, it's staying in investments in the banking system, and it's not getting out in the real world.
I see. This sounds like a virus inside of a body just slowly incubating.
Is that what it sounds like to you?
That's the way I'm hearing it from you. I could be wrong.
It's a very strange world we live in. So let's get to talk about negative interest rates. So there are about $17 trillion of bonds from sovereign countries, mostly in Europe, that if you want to buy their bond, you have to pay them more for it than what you're going to get back. That makes sense to you?
Why would you ever do that?
There's a number of reasons. One, they believe there's three major reasons. One, you're speculating, and maybe you're American and you want to. You think the euro is going to go up in value, so you can buy a bond denominated in euros, and then when the euro goes up in value, even though you lose euros, when you convert those euros to dollars, you actually have more dollars in your pocket. The second reason is because some of these pension funds are required to hold a certain amount of these bonds in their portfolio. And the third thing is speculation. You're speculating that if I buy a bond for $1,010, the European Central Bank is going to come in and buy it at $10,020. So I'm going to sell it to the greater fool, which is the central bank.
The greater fool.
Right? And the central bank can print unlimited amounts of money. So whether it's the European Central Bank, called the ECB, or the Federal Reserve, they can create unlimited amounts of money, and they can buy whatever they want. It's no skin off their back, right? They don't have to earn it. They just make it. So we've had these things called negative interest rates, which goes against everything in finance, which is about time, right? So time is worth something. And so if a dollar in your pocket today is worth more than a dollar that's promised to you in the future. So if you had $100 and I wanted to borrow that money, you'd say, okay, Tom, you're a good risk. I want 110, right? I want $110 in a year because my $100 is worth something, and I want to make some money on top of that. There's risk involved lending money to you.
Right. So you need
you need something more than 100. Today, negative interest rates is, well, you give me $100 and I'll give you $99 back. Isn't that a good deal? Doesn't make any sense, but that's what's actually happening in the real world. It's totally nuts. It's ludicrous.
Wow. This sounds like quite the crisis that's developing further and further. I've heard a lot of people speculate for the need for some type of economic revolution, so to speak. And some people have put hopes in things such as Bitcoin, which still sounds like a bubble from your perspective, trying to get away from that centralized banking.
Yeah, the rationale for Bitcoin is that it cannot be altered. It cannot be loaned again and again and again.
Okay.
Okay. So here's what banks did in the early days. Banks were really goldsmiths, and were vaults. They were vaults. You had gold coins, and you wanted to put them in a safe vault.
Right.
So if I'm a goldsmith and you have gold, you come to me and you put your gold in my vault, and I give you a paper receipt saying, Joel and Brittany, you each have 10 coins of gold in my vault, gold coins, and so what started happening was, because people knew that the gold was actually there, the pieces of paper became money. They were used as exchange for goods and services, and so what ended up happening was the goldsmith would issue 10 receipts for 10 ounces of gold, so you could use them as transactional pieces of paper, right? Then the goldsmiths figured out that only 10 or 15% of the people would come back over a two or 3 year period. And in the meantime, they'd get other people to invest, to put their gold in their vaults. So now, not only did they give you receipts for your 10 ounces, they decided to lend the money out, the gold out, right? But instead of lending the actual gold,
They just lend receipts.
they created new receipts. And that's called the fractional banking system. That's creating money out of thin air, right?
Fractional rings.
And it's the same concept. So it's been going around for years, and we've adopted that in the United States. We've allowed bankers to control that, and now we've got the problem with no regulation. See, it would work okay if we had regulators that actually were regulators, but the regulators aren't regulators anymore. They get jobs in the industry for big bucks. So I'll get to Bitcoin in a minute again. So the regulators. The regulator that worked for the SEC for 5 years to study algorithmic trading quit and went to work for an algorithmic trading company and got paid big bucks.
I bet he did.
Right? So that's what is happening. And so with Bitcoin, people are saying this cannot be modified. This is if you have it in your register, it's good. And so the confidence that if you have the Bitcoin,
Right.
because the blockchain is keeping a record of that,
Right.
there can be no hanky-panky,
Right. They can't alter it.
right? But that doesn't mean that bubbles can't be created because Bitcoin was a bubble. It went up to 18, 19,000.
Yeah.
Why? Because money was flowing into buying Bitcoin, and it drove up the price. The other issue with Bitcoin is that what happens is a lot of financial people can manipulate markets through the derivatives markets. So a derivative is something that's supposed to derive its value based upon some underlying thing. So you have stock options. So the option is based upon for IBM, for example. Let's use IBM. You can get options on IBM, and the value of those options go up and down based upon the underlying movement of IBM, right? So the price of the derivative is derived from the security. The problem is that you can borrow more money in the derivatives market, so you could actually buy and sell derivatives that actually affect the underlying security. It's like the dog wagging the tail, right? So with Bitcoin, there's a woman who worked for a big company and may not have done some nice things, and she created a derivatives market for Bitcoin. So you can buy options, and you can buy and sell options on Bitcoin. Well, if you have enough money and you can drive up the option prices, you can drive up or down Bitcoin. So you can manipulate Bitcoin just as easily as you can manipulate anything if you allow leverage, which is borrowing or the use of options or futures. That's called leverage. If you allow leverage in a market that's tied to another market, you can move both markets easier by using more borrowed money or more leverage.
So it's like if I have a stick, right, and it's just one stick, I wag it around, it'll stay a stick, and it won't create much more of a difference than my arm can move. But if I tie a string to the end of that stick, and then I tie another stick to that string,
you can,
now I can really inflate or deflate the direction of what we have here, right?
And the analogy that you're making is that the strings attached is the leverage you're using.
Right, the attached markets of leverage.
Right. So everyone knows leverage in terms of a house, right? You can, if you put 20% down or 10% down on your $100,000 house and you borrow $90,000, you can leverage your return by using other people's money. So if the price of the house goes up to 110, and you owe 90, well, you've got $20,000 of equity in the house.
Mm-hmm.
You started with 10, now you got 20, you made 100% return,
Yeah.
right? So you can do the same thing and so the more leverage you use, the more debt or leverage you use, the more you can drive up prices, right? And as prices go up, the more money you make,
Right.
the more leverage
So,
you use.
anytime you can create almost that ethereal money, it will create bubbles. Brittany,
Yes.
do you have any questions?
I do have a question actually. So this isn't something that you have to really worry about, but I will. So there's this whole, talking about all the different bubbles and anything. What about the bubble with the student loan debts?
Oh,
Where do
boy,
you think
yes.
that's going to head?
Yes, I talk about that in my class all the time. The student loan bubble, it is a bubble. I mean, it's grown from about $400 million in 2002 or 3
I mean, this is just a public house of pure bubbles
To
that
over-
everyone's swimming in.
over $1.6 trillion. So, so again, here's the problem with the student loan bubble. The student loan, in that housing bubble, there was something called a ninja loan. Have you ever heard of a ninja loan? Okay, so loans were being made to people with no income, N-I, no job, N-J, ninja, applications, right? And the A stood for applications. And there's a lot of fraud going around that because then when the banks went to foreclose, they were fraudulently recreating paperwork which was needed in order to take to bankruptcy court and whatnot. And so there's a lot of fraud around that, but people who had no income and no jobs were being lent money. What is a student loan? The person has no income and no job.
Right.
And so some people are going to be able to pay it back. The engineers, the scientists, the business people, because they're going to get nice paying jobs. The English majors, the philosophy majors.
What about the
liberal
finance
arts.
majors?
Finance majors? We take care of our own, thank you very much. Business majors, finance majors, they're not going to do so well. And so now you hear about Bernie and other people saying we're going to wipe out the student debt. The issue is, though, who owns the student debt? Who's on hook for it?
I mean, it sounds like it just keeps getting sold to companies and companies.
We are, right? The federal government has now taken over the majority of student loans. So if these you kids don't pay back the loans, the deficit, an asset that the federal government, which is us, theoretically, got to go down through the floor, right? So what ends up happening is that all these loans get wiped out, and so what do you do? That's the problem with all these debts. A lot of people say, well, let's just get rid of the debt in the Social Security fund, right? Because the Social Security fund has these IOUs from the federal government because Congress took the money when there were surplus taxes. Congress just took the money out and gave the Social Security Administration IOUs. They're called bonds. But if you wipe those out, what ends up happening is it's not going to do much. It's not going to change anything. And the rationale is that there's $2.6 trillion of money in an account. So when the receipts from Social Security on a yearly basis go below the payouts, which has now occurred, there's money in that trust fund. So if the government wipes that out and says, okay, there's no more debt in the Social Security fund, all that means is that the federal government's going to, on a yearly basis, going to have to issue more debt to pay the difference that's needed. It's not going to change anything. It's called an accounting gimmick. And so
A
there's
gimmick.
It's a
Okay.
gimmick. All kinds of people are coming up with these ideas, and none of it's going to work. What's going to work is what we really need is we need a brand new economic system. We need a brand new banking system, and we need to change everything. And we're never going to get that until we have some pain.
So what you're saying is that
Just to be a downer.
something really bad has to happen before enough people are going to care to create some type of revolution in order to alter the current system that we have in place, right?
Yes.
That sounds very similar to what we recently talked about. Well, not recently. A long time ago talked about. Man, we've been doing this podcast a little while now.
Us or you?
No, us. What I was trying to say was it's the same when we were talking about climate change, that until enough bad things happen, we won't get enough people to care to actually change it. So it sounds very similar to the same thing in this financial world, where enough people need to care before they will alter anything, right?
Right. So the one takeaway I will say, and now how long we continue talking, is this: negative interest rates are a sign that something is wrong, something is seriously wrong. So the reason why banks are trying to do this is because it's all tied to growth. If you go back and take out all the debt, the excess debt, the 200% excess debt that people have spent, borrowed and spent, then really our growth is almost flat over the last 20 years. And that's, in my opinion, and many other people's opinion, because it's the cost of extraction of energy has everything to do with growth, right? So when we could pull out cheap oil, we could create all kinds of wonderful things. And a lot of that energy translated into profit and growth. But now that extraction of energy is costing us much more, we should be living in a zero stable growth environment. Well, the banking system and the economic system is all built upon growth, right? Either grow or die. And that's not going to work. And so now all these systems they're desperately trying to cling to what they've been created for.
Yeah. I mean, they have to grow or die, right? I mean, it's the same way that plants or animals or any species has to eventually develop. So when you say it like that, it almost sounds like people are trying to model certain aspects of the system based on natural laws.
Yes.
Okay.
Yes.
Well, interesting.
Yes, I mean, the short answer and the long answer is yes.
Wow. Okay. So Brittany, do you have any more questions?
So essentially what you're saying is that we need to have a revolution, burn down all the banks, eat the rich, and live in anarchy.
Eat the rich, live in anarchy.
Yeah.
I mean, I don't know if it needs to be anarchy. Maybe some type of revolution.
Yeah.
You say potato, I say potato.
So
Actually, in class the other day, I played "Eat the Rich" by Aerosmith.
yes, important. So,
But something's going to happen because as the rich get richer,
right, something's got to happen.
something's
So,
gonna happen.
many people are, you're talking about negative interest loans. So maybe instead of investing in that, maybe you should invest in something else like a nice machete or, pickaxe, chains,
a nice bus to convert into a death machine.
Yeah, death machine, dehydration, so that you can take meals, dehydrate them, you're good to go.
Yeah.
I am not making any recommendations or any advice whatsoever. Okay?
I don't know what the periodic roundtable's official agreement for what you should and should not invest in, but I'm just saying, if it comes down... Gentle suggestions.
Yeah.
If you have to eat the rich because we have a crisis and it blows over...
I tell you, it's one reason I became a vegetable gardener at age 55.
Huh. So it sounds like investing in a nice, even weighted machete and in veggie gardening experience are valuable things.
Well, I did notice that right near your guitars, which is so hippie-ish, right? You've got two samurai swords on your wall. So I think you're good to go.
Yes.
One for each of you.
Yes. So we have invested in some nice katanas. But, not everyone needs to go for the katana. A nice weighted machete will do just fine. So I think we're ready to...
We're good.
We're good. I'm prepared.
We're ready.
Yes. Yeah. Well, by the way, all the stuff I've been saying, it's why preppers are doing their prepping.
Yeah, prepping.
Because of all new prepping, right?
So I do have one more important question before we end the podcast or anything.
By the way, I've been called a prepper before in class.
Really?
Yeah. Some students said, "Are you a prepper?" I said, "What do you think?" And I didn't answer.
Nice. You got to leave them guessing.
Go ahead.
So just one last aspect, because this is typically a science podcast, but we are very fortunate to have people that have expertise in other fields that are based off of science backgrounds, whether it's statistics or mathematics or whatnot.
Pseudoscience.
So, pseudoscience, yes, I like that phrase. So, is that what you think finance is, the study of finance?
Yes.
That field is pseudoscience.
Yes, because all of the economics and financial models are based upon that we can grow forever. We live in a finite planet with finite resources, and we're going to somehow grow forever because we're just so wonderful, creative beings, right? And the illusion is that's been created because of cheap energy. And so because we can extract energy very cheaply, we could do a lot of stuff with it. Cars now take the place of 400 horses, so we can do a lot more work. We can do a lot more productive things.
Mm-hmm.
So now that energy is going to we're hitting the wall with energy. The system the whole basis of economics, which is grow, and the finance grow, it's not going to be valid anymore. So it's pretty funny. I was on that another story. There's a guy from so markets are based upon the efficient market hypothesis, which says, and one of the assumptions underlying that is people are rational. They make rational decisions.
None of my purchases in the past month have been rational, other than maybe some food items questionably.
Exactly. And then there's a guy named Kahneman who totally disproved that in 2002, and he won a big award, saying the whole financial underpinnings of finance is totally wrong. So there's a new guy out from MIT. I forgot his name, Louis. He's come up with this thing called adaptive market hypothesis, and he says that in extreme periods of when the market goes down, and extreme periods of markets go up, people become irrational. And I laugh. I tell people, as an investment advisor for 20 years, I could have told you that in like 5 seconds. I don't need any statistics to tell me when the market goes down, people go haywire, and when markets go up, they go even more haywire.
So no matter what, either way,
it's
going to go haywire. People are going to make irrational decisions,
exactly.
Except for when they buy a machete and invest in veggie experience.
If that's what you say, that's what a rational man's supposed to do. Yes.
So as long as we wrap this up, I just want to make sure that I get some of the basis. So we need a lot of money in order to make money to get rich. So we got to start really big, right? So that we can get big. But we aren't big, nor do we have money because we're grad students. So that'll never happen.
But after this wonderful podcast, I'm gonna send your listening ship into the stratosphere, and then you can make big bucks.
So we got that one. Okay. The next point: fracking is a Ponzi scheme, right?
Fracking is a financial Ponzi scheme.
Perfect. All right, just want to make sure.
Yep.
So not only is it bad for the environment, but also a Ponzi scheme. Other thing is seeing almost like putting a rectal thermometer into the economic system is we can see that there's clearly some sickness due to the negative interest rates.
There is a blockage. There's
A blockage. Okay, and then something which was very interesting is you said future consumption. I've never thought of my savings account, the $5 that's in there, as future consumption, but it's good to think about it that way.
Why do you save, right?
I mean, as soon as I get paid enough to do more than just eat, then I'll tell you. But and the last point that I think I've learned from our conversation, which I really appreciate you being on our podcast, is not only should we start a religion, we should also start a bank.
Oh, absolutely. And they should just be tied together.
Tied together.
Yeah.
That would be the best of both worlds.
Well,
Can't lose.
Can't lose.
You
So
can't lose, you can't
we,
lose.
if you could get the documents for our new bank on my desk by next Monday, that'd be great.
Absolutely. Mr.
Perfect.
Serrano.
Best way to rob a bank is to own a bank.
Perfect. Well, Thomas, thank you so much for being on the podcast.
It's been my pleasure. I appreciate the honor of being
It's
part
it's
of
been
the
marvelous.
Periodic Roundtable.
And if we had more time, I have no doubt that you and I will have more personal conversations about this. And if our listeners have any questions about this, please email us or contact us. They can do that, right, Brittany?
Yeah, they can. So they can email us at prtcast@gmail.com. You can also find us on social media, Facebook, Twitter, Instagram, under PRTcast.
Oh, you know what? Other thing that I've also learned about this economic and financial conversation that we've had with Thomas.
What's that?
Is that, more economical and financial support from our listeners would also be phenomenal.
Oh, wow, that would be
It
fantastic.
would be amazing.
Yeah, and you know how they can do that? They could
How
go to our
can they?
Patreon.
Oh, right,
Our
that one.
Patreon under PRTcast and donate.
Thank you. And Thomas...
To finish up, this conversation is not advice. It's for informational purposes only. Thank you very much.
So anything Thomas has said is not advice, only information. We still stand with potentially investing in swords or some sharp object for the upcoming revolution.
Absolutely.
And maybe get a book or two on growing veggies.
Mm-hmm. Yep.
Okay, well, thank you guys so much.
Hey, thanks for having me.
Thank you, and we'll be back again next week with something.
Yeah, we'll be back next week with something.
All right.